Hi, everyone. This is Jason Bierk of Wall Street for Main Street. Welcome back to another Wall Street for Main Street podcast interview. Today's special guest is a returning guest. I think I last interviewed her in January or February. It's time for a mid-year review. She's the founder and chief market strategist at LaDuc Trading. She runs a professional trading room each day for many, many hours during market trading. Samantha LaDuc, thank you for joining me again.
Thank you so much, Jason. Pleasure to be here.
So, Samantha, we're recording this interview on Thursday, July 25th, 2024. Let me get some market information data first for our listeners out there. The dollar index has held up. It's at 104.4. We've gotten a really big spike in the VIX lately. I think it was stuck around 12 or 13 for many, many months. We've gotten a huge pop in the VIX. It's up to 18.46 today. The last week to 10 days, it's started to rip. The 10-year U.S. Treasury yield is back down. It's been a roller coaster, though, the last 12 months. It's back down to 4.25%. And the gold price has had a little bit of a correction. It's down about 50 or 60 bucks in the last few days, down to $2,365. I want to get your thoughts, though, on this narrative that the mainstream financial media is talking about lately for the last week or two. They've been repeating constantly that there's a large-scale sector rotation now from the Mag 7, the large cap, big technology stocks, into small caps. Do you agree with that, or do you think something else is happening?
So I have a lot of opinions and experience with identifying rotation. It's really my kind of mother's milk, if you will. What I do from a market analyst perspective is to use macro as a backdrop, of course, to look for event risks that can be market moving, not just because I run a live trading room, but because I am setting up for clients, both retail and institutional, protection for those who have portfolios, not to mention lots of active trading and active investing, including on a chase timeframe, those who are really, excited about a particular directional move, using options and short duration, like what we have right now with this correction. But my point is that I look for it. I look for sector rotation. And I have a saying, in lieu of sector rotation, there will be volatility. So this recent phase I have been in sync with because it is something that I focus on. When we started to get kind of the AI bubble talk, which was, we've really, really extended this run, both because of, Fed and Treasury easing for the most part, since this November 1st Fed pause and the Yellen Yahtzee I like to refer to, which is Yellen provides lots of short duration bills versus longer duration bonds and notes for the market. It's very liquidity pleasing, right? So we've had this amazing run into the hot sun of equity markets since that November 1st low. So then we get into this kind of, AI's really extended, and we had big wirehouses coming out, right? We had Sequoia coming out, PE saying, yeah, we think it's cooked. Goldman came out with a big report. Citibank, Barclays, Dan Niles. So it was really this ringing the bell at the top. At the same time, valuation was extended. So we just really needed a little bit of a push to cause this deflation in assets. And we got it with a CPI print a few weeks ago that was negative month over month for the first time since May of 2021. And I was tracking not just the kind of AI narrative, when does it reach its zenith, but also deflation impulse that would help bring yields down and, kind of cause this valuation and forward earnings to be revisited as, okay, we really need to take some chips off the table into earnings season. So it was really a perfect storm, honestly, before this rotation triggered. Then on July 10th, which, we're doing this recording on the 25th, I did a client post that, and literally the title, Option Flow is Stalking a Market Top. So at the time, there was a ginormous bet. A big whale came in. So market structure matters to me. And a big whale came in and basically said, no, this is a do not pass level, which happened to be 5650. That corresponded with a NASDAQ 100 target that I had given to clients prior, months before, of around 504, 507 area. Just so happened they hit at the same time. and we rolled over. So not only did we have an option flow dynamic, we had the CPI with a deflation impulse. At the same time, we had the AI bubble narrative turning and Fed rate cuts picking up in speed as they had not been really priced in, but now they're like, oh, you know what? I think we're going to see one in September. So fast forward one day, the Qs topped and the rotation started. So it is very, very telling as well. We have this kind of function called hedge fund factor rotation, and it's where market neutral hedge funds, they're called pod shops for those that are in the biz. But the point is they are long the VIP stocks and they are short, let's call them oversold value, but they're also affectionately referred to as dash for trash, right? So the stuff that is in protracted downturn and they just keep shorting, and the stuff that's in a protracted uptrend, Mag 7, Mag 10, right? The FANG stocks and then some, the semis, they just keep pressing. And then there's an unwind that occurs when they have to cover short, right? Cover short the value rotation and they sell out of their VIP stocks. So you had the perfect storm for a rotation, right? You had the options coming in, the inflation, the turning deflation, et cetera, et cetera. So that is when I wrote to clients on July 11th. The narrative shift can absolutely contribute to a sizable unwind in the concentration risk that has suppressed volatility. Know what you own.
Do you think that this is a short covering rally, a short squeeze in for the small caps, or do you think that this is kind of the bottom with the Fed rate cuts? So if the Fed only cuts rates, 1/4 point, or it's really slow with the rate cuts, do you think that that's going to put a bottom in the small caps, or do you think that this is just a bear market rally or a dead cat bounce for the small caps then?
No, I think that this is very much started by hedge funds short covering, and you can absolutely have a trend reversal from short covering. But small caps, as you also know, in the Russell 2000 constitute 40% of unprofitable companies. And when we have an economic growth slowdown, they are going to be hit hard. So it's not that small caps are going to be the best game in town. There are some large cap value plays that'll do a lot better. And more specifically, the safety will pay. So this kind of, let me just kind of frame this. The de-risking that's happening or has been happening now, right? Because I've been on this since literally July 9th, 10th, all the way through, even July 17th. Is the forced selling done in tech? No. So I'm still seeing that they are de-risking out of the concentration bet and they're short covering, but it's not a rotation. That's not necessarily the right word to use. They're just de-risking. In other words, we just lost, let's see, the other day, what was it? 1 trillion, 2 trillion. Okay, we lost, case in point, $2 trillion in 10 days in Mag 7. That 2 trillion in market cap did not rotate into small caps. No. That just came out. At the same time, the funds were covering and the safety plays were in play, meaning look at staples, look at healthcare, XLV, it's all-time highs, right? Pushing higher. Staples, of course, home builders as the 30-year is falling, the move index is softening. So we have this, rotation into defensives, also utilities. They're not suffering. So this is very much a de-risking moment for growth. And it's a narrative shift for sure out of concentration risk. It is forced selling. It's been very, very controlled. This is not panic. Only did VIX start moving higher. And this was also kind of a really, really great timing because last Monday, volatility of NASDAQ actually gapped above its 200-day. So I knew that NASDAQ was going to get hammered even more. But this is part and parcel of we are now forcing recession risk forward. And I think that that's why Bullard came out just yesterday, was it? and he said, I changed my mind. I'm not a hawk anymore. I think they should actually cut next week.
Wasn't it Bill Dudley too, the other former
Dudley,
Fed
Dudley. You're right. Yeah. So the point is that they're now kind of shifting the narrative from inflation to deflation into the rest of the year. That was my main kind of second half of 2024, where I warned clients, be careful. This is actually going to be a fabulous time where safety pays, tech will have forced selling, and Fed rate cuts are coming. And yes, it was the Bullard op-ed in Bloomberg that highlighted all of a sudden, what do you mean? What do you mean got recession risk? Where'd that come from? And it's kind of a head scratcher for some folks because they look at the GDP print that we got today, right? Which was like 2.8%. But a lot of that is inventories that are pulled forward, worried about, maybe a Trump presidency, and they, suppress the dollar further and all those tariffs on China companies and commodities. So they're kind of getting all their inventories pulled forward as an example, right? So there's also a lot of spending that gets pulled forward in that the GDP print, which was quite strong, but it's not going to repeat itself later. Growth abroad is still abysmal. Corporations are hit by a strong dollar relative to local currencies. The trade deficit is still widening. So I don't think that this GDP print that we got today is a sign of economic strength. I think it's an outlier, and it's going to revert.
I also think the small caps are a better sign of the Main Street economy because they're the jobs creators, and they also cater to what the middle class and lower income consumers, a lot of the small cap companies do, besides like Amazon and Walmart. But a lot of these small cap companies, their balance sheets, they don't have access to the corporate debt bond markets with better collateral, so senior secured credit. So they have to use variable interest rate debt or revolving credit facilities or some type of other, variable interest rate credit card debt for a corporation. So the Fed cutting by a quarter point or even a couple rate cuts, it's not going to fix things with their the amount of debt on their balance sheet. And then also their customers are potentially, especially if they're middle class or lower income consumers, their customers are going to be tapped out too. And we're seeing that with the credit card data. The savings rates have collapsed, and the amount of credit card, what people are using credit cards for now. I think they're using credit cards for groceries now.
So that's part of the Main Street suffering under the high interest rates. We know that inflation is compounding. And that's how real people are measuring inflation. Our health insurance premiums, our home insurance premiums, our auto insurance premiums. It doesn't matter what we look at, food costs, those prices aren't really coming down, are they? They are compounding. And we've had more inflation in 3-4 years than we've had in a decade before that. So how Wall Street measures it is, of course, the rate of change. So when I'm talking about that negative CPI print, that is important for how bondholders and such are looking at the impact of the inflation getting under control, turning deflation, Fed cutting, Citibank out saying they're more likely going to cut 8 times. This is and people are like, what's going on? We still have inflation. But the reality is that this is actually a telltale sign of how far behind the curve the Fed is. Other central banks have already started cutting, not Japan. We already know they're a freak of nature, but that is a sign of global credit demand falling. That's already stress in the system. So there will be a Fed cutting regime, and many think that small caps are getting bid up because it's going to be beneficial. Unfortunately, it's still going to hurt a lot of companies. So in other words, the economic growth that is slowing, the unemployment rate that is growing, we do have a lot of risk actually out there, so much so that for the first time in years, like I wrote about this in July of 2023, that wage inflation delayed recession. I have not been on the recession kick once. I've never said soft or hard landing once. I actually can see a very firm case for recession risk getting pulled forward, and the election drama only makes it worse.
So the recession risk being pulled forward, is this because of bad DC policies from Congress? What they're projected to spend fiscally over $8 trillion for 2025. Doesn't really matter who's in control of the White House. It doesn't seem like anyone who's in control of the majority of Congress wants to actually cut spending. So it seems like the government is focused on kind of spending insane amounts of money no matter what.
There is that. There is that. But it's also what's happening. Let's kind of like my worldview. Okay. So my worldview, credit spreads have been greatly compressed. This is not a credit stress event. We have so much spending by the federal government, and we can see that in the BLS data that at least, if we trust it, we can see it in the GDP estimates as well. But this is still a function of of crowding out a lot of private investment and a lot of organic growth, right? This is top line, or this nominal growth versus real. Anyway, credit spreads are compressed. Volatility has been suppressed, and this over the years. We have right now a letting go of volatility, which was a really great tell that leading into the past week, that it was more than just quote unquote rotation, right? So the fact that we actually did have volatility rise up is mostly because of the rate differential that's happening between US and Japanese yields. The dollar yen coming back down from 161 to 152. The dollar is seemingly innocuous. Just doesn't seem like it's going to cause any problems. But in reality, the yen has risen up very strongly. So we have to watch that, because that's when volatility becomes unhinged. And right now, we have a currency that's also been manipulated or devalued in in foreign countries. And they want to keep kind of currency easing underway so that our equities continue to get supported. All of this is policy interference. There's no question about it. We've had Fed, Treasury, and White House policy interference, and that has helped to keep credit spreads compressed, volatility suppressed, and currency depressed. But do
you mean stock volatility, right? Because there was a lot of volatility. The 1 year chart of the 10-year US Treasury yield was a roller coaster with all the yield spiking. I mean, we almost got to 6 or 7 months ago, quite a few times. Now here we are. We're almost back down to 4.2. I think we got below 4.2 in the last couple of weeks. So are you surprised that we've had a lot of U.S. Treasury yield volatility versus not the volatility in the stock market and the VIX, that we've had more bond market volatility instead?
No, I think that bonds were already sold, right? We've had 3 years of historic selling down in bonds, and the volatility in move recently was a bet that I had in March that we would have the move index, which is the volatility of the Treasury, fall into the summer, and yields would come down into 4%, the 10-year. We haven't gotten there yet. We're kind of still hovering on that 4.2%. But I also believe that we'll get more volatility, not this recent selling off of tech, right? But that we will have more volatility, wider spread equity volatility when we get above 4.2% in the unemployment rate. We're not there yet. We're close. When we get below 4.2% in the 10-year, we've touched below it and then popped right back up. So it's kind of test. And when the 2-year falls below 4.2%, we've gone from 5.2, 4.8, 4.5. We're getting closer to the 4.2 and then breaking it. Those 3 levels are going to be really big tells for me that they're going to start cutting more aggressively for fear of actual recession.
Now, if we do get the spikes in the volatility, and you're saying like the probability starting to increase in the VIX, does that mean all the institutional investors, the hedge funds, the family offices that have been piling onto this leverage short vol trade, and it looked like the VIX was capped for months and months, does that mean these leverage short vol players that were selling volatility, they're going to get hammered too? They're going to get margin calls?
We need more. We need a macro trigger. So it isn't just one and done. This current little wave that we have from, let's say, 12 to 20 in the VIX is just releasing some of the air out of the balloon. We're talking about reassessing valuations on some extremely overbought stocks, right? And some of the reason why these oversold value plays are popping up, by the way, is because they are just artificially suppressed because of this dispersion of going long tech and short value. So growth value rotation is a thing that I follow very closely. But in order to have what you're talking about, we need a macro trigger. Right now, we have stealth quantitative easing. We have, monetary easing implied or actual. And they're going to start cutting. That's a worry because they're afraid of deflation. They're afraid of global demand of credit falling, right? We've had currency easing. They don't want the dollar to get too high. They cut because they don't want the dollar to spike higher. So all of this is liquidity producing versus seizing, right? When things, when liquidity seizes up, that's when we get credit spreads blowing out. So right now, it's been very, very controlled. Even the recent selling that happened that I saw literally roll over in my growth value ratio on that July 10th. And we've gone right down into support, what I consider support, so we could have, a really strong counter trend bounce. But big picture, we're like one more high to go. One more high to go, and I think we're done for the year.
That's for you. The high you mean for U.S. stocks like the S&P 500 or the NASDAQ 100? Is that what you're talking about?
Correct. So in other words, we could, right now it doesn't look very viable, but I'm just saying once we get this recent indigestion, which is obviously beautiful shorting backdrop, we're going to have a reflexive bounce of size that's going to suck in the bulls, and then we'll go back over. So right now we have the deflationary impulse. We have the revaluation of companies that has triggered de-risking and deleveraging, but nothing of big size yet. That's all I'm saying is bonds were already sold. Equities are now way too bold, and they're just mean reverting. So if you look at, I showed a chart to clients. It's called RSP to SPY. It's a ratio, right? Where you have an equal weighted SPY relative to the tech heavy weighting in SPY. You could do this with NASDAQ too. You'd see the same thing, right? Equal weight NASDAQ versus NASDAQ. You will notice it is the largest divergence ever in the history of the instrument itself. And that's because we've done so much in the form of leverage and this dispersion trading that you're just talking about, right, with the VIX shorts, that we absolutely set ourselves up for a massive air pocket of risk from this concentration risk unwind. But we still need a trigger. We need the yen moving higher. We need, Fed rate cuts getting a little bit more aggressive because of fear of recession risk, because of global credit demand falling, because of unemployment spiking, because of the 10-year falling. Remember, people with money and also corporations with lots of cash on the sidelines have been making money on their money. So this pullback in interest rates will also affect their ability to continue that gravy train. So we actually have a lot of risks forming right now that make me, even though small caps are bid and they're staying supported, and I have a particular level, which is IWM 212.25, $212.25 on a weekly. It needs to hold above, and it's firmly above that, and it can stay there and it can grind higher. But it's more interesting to me what happens with the concentration risk of MAG 7, MAG 10 coming back down to earth. That is actually a much bigger issue because that's on everyone's balance sheet, from mutual funds to hedge funds to passive indexing. That is what is the reason for the season for attracting so much money from abroad into our equity market, and will be the reason for pushing it back home.
I was actually going to ask you about the other central banks, or the other central banks in the G7 non-Japan that started to cut interest rates. That adds liquidity to the system. The People's Bank of China just did a couple surprise rate cuts. That's going to add more liquidity to the system. You said that you think that I would argue that a lot of that liquidity went into the S&P 500, the NASDAQ 100, and the Mag 7. Do you think that that liquidity that those other central banks added from institutional investors and banks, is that going to go somewhere else other than the large cap U.S. tech stocks soon?
Well, you're talking about liquidity as it relates to foreign versus what I consider the kind of function of intervention liquidity. So I think China cutting is a way to stimulate their local economy. China cutting their rates is also a form of competitive devaluation with Japan. All of this competitive devaluation actually is to better withstand the U.S. Higher yields and dollar relatively. So they're really, I think, just trying to compete. And that's not necessarily liquidity that's going to come here anymore. We've already gotten it. We already got it. So now it's the risk of falling yields and rising dollar, even though so many are fixed on, Trump Vance ticket coming in and suppressing the dollar for, American advantage. I actually see the opposite. I actually see the strength in the dollar is going to continue to hurt emerging markets and U.S. corporations doing business abroad. So this is why I think we've got maybe a quarter left, maybe 2 quarters left of good tech earnings, and then we're going to reverse, and we're going to see this impact of strong dollar and falling global credit demand, and we're going to get hit in 2025. And I think we're going to get hit hard.
In terms of the macro picture, I think there's worse inflation in emerging markets and other countries because those currencies have been weaker against the dollar. The dollar has held up relatively strong. Meanwhile, like the Korean won, the Japanese yen, a lot of those other Asian currencies have had weak currencies. So I would argue that the inflation has been worse in those countries. Also, I've heard, I spoke to a manufacturing contact in China. What he said, and he spoke to a lot of manufacturers there, is they think the Chinese government, if Trump wins the election, they could devalue the yuan further to try to offset all the tariffs that Trump is planning. So their analysis is that if they devalue the yuan more, it will offset the tariffs that Trump is planning on Chinese goods.
Yep. So this kind of brings us into this yen carry trade a little bit, right? So we've had clearly a very strong. We talked about gold, I think, last time, where it was hot fire flames and it was used as kind of a bond proxy, right, by central banks. But now it's digested. We're not kind of really focused on the strength of gold and silver. We're looking a little bit at, I am anyway, big picture. It's a great trend, but in the short term, it can undergo some pretty wild digestion as commodities have been beaten down. So, copper isn't being stockpiled by China anymore. We have some already kind of clear signs of weakness and deflation, for lack of a better word, or economic growth slowdown in the commodity sector. I'm not bullish on oil. I'm definitely looking at yields very differently than I did last November when I made a call, that we would have higher yields into the end of this year. I think we'd go lower. So I've had to reassess my oil call. I've had to reassess my yield call because I see the risk now of global credit demand falling, unemployment rising, the 10-year and move index weakening, not to mention rate cuts getting pulled forward on recession risk. So can they come in and do another intervention? Sure, they have, and that's what the market's betting on, but it has diminishing rate of return. So the unwinding of yen shorts is also contributing to this kind of global risk-off environment. That's for sure. How serious will that get into the end of the year? That's enough. That bears watching.
So it sounds like you laid it out that there's going to be an argument to accumulate defensive plays like cash, short-term treasuries, utility stocks, safer defensive dividend companies, kind of the consumer staples that people would buy, maybe some of the hospitals or healthcare insurance companies.
That's been in play. It's been firmly in play for months now. So it really has already been accumulated, and it's staying very nicely firm during this kind of bloodletting in the Mag 10, or call it more than Mag 10, because you can see lots of semis are getting hit with tech outside of just the AI tech ecosystem. So there's a lot of support that I've already called out and seen and continue to see in the safety plays of XLP, XLV, XLU. And of course, that does kind of bode well for some of the small caps, but they're really large cap value that are doing better. So I don't think that's going to go away. I think that's going to continue.
Well, I also think that the market was wrong with overvaluing a lot of the big tech companies and the artificial intelligence place with the semiconductors, like you said, in valuation, because I've been reading some of those reports that were the people referencing the amount of capital expenditure that big tech, so Amazon and Microsoft and Google and Meta all have to spend. So they have to literally put in, we're talking like many billions of dollars for these next generation data centers. So the utility companies, the data center service companies, copper miners, nuclear power uranium companies, the utility companies, they're going to be the beneficiaries of this capital expenditure boom. So long term, I think there's more growth here than the market thinks. It's just that this is not like a short term trade, though. I think like big tech is committed to this, and they're going to be investing many billions of dollars extra per year now going forward. I think Amazon alone, they're projecting 170 billion in capital expenditure, and then by over the next decade, I think $1 trillion, Goldman Sachs says. But obviously, like pricing that in immediately is stupid. But I think it's a long term play with some growth.
And at the same time, this is going to hurt stock buybacks, which has been a very, very productive way to play long the market, especially NASDAQ, right? They got tons of money and they're putting it into stock buybacks, but in the past, but now more of it's going into CAPEX. So I think it is going to be a little tug of war on how we stay moving aggressively higher, since the narrative for AI has shifted, since recession is starting to get at least on the radar, not just the worry warts. That's not it, because like I said, I really was very, very convinced last July when I put together my big paper, right? Wage inflation, delayed recession, spending was robust. It's not that spending has given up. It's so bifurcated, right? Those, you just talked about it, right? That those who are living without assets, without homes, without businesses, without 401k plans and the like of size are suffering. So this is where we're going to see, I think, more of the crowding out by government, more of the Fed pushing, too late, where they were late to hike, and they were late to stop hiking, and now they are probably late to cutting. We still have fiscal dominance in full view. You started off talking about fiscal spending and how this is really, it doesn't matter who's coming in, Biden or Trump. What if RFK is elected? Or what if RFK upsets the apple cart to our two-party system, and there's much more election risk than is currently priced in, or spending is curtailed than is currently priced in? I think we really have a good crystal ball on how it's going to go into the end of the year, which does create worry. And that worry is starting to create some of this carry trade unwind and factor rotation, that which we just spoke about, which is selling some of the VIP stocks and covering short. So I know that there are some that are very, very excited that small caps are going to rise up and lead, because the market will broaden out. And so far, they have done really well in the past 2-3 weeks, but they have to prove it still. And I would like to kind of just remain cautious and for the first time anyway, really push more into the safety pays. That's been a theme in the past few weeks, and it's doing well.
And it sounds like a lot of different macro cross currents that are conflicting and confusing, a lot of distortions from central bank, not just the Federal Reserve Bank, but other central bank policy and government policies too. And this is causing all the distortions here with the wealth disparity and different companies and sectors where it looks like one sector is doing really well and another one's doing really bad. So it's all the distortions, the lack of free markets that's allowing, the deflation and bankruptcies that would have happened in the past. So post 2008, like you said, with the Fed policy, I mean, I would argue post 2008, Samantha, the Fed just became fully reactionary. So they're always behind the curve. And then when they start doing policy, whether that's cutting rates down to zero with zero interest rate policy or quantitative easing, they always do too much of something. And then they break something really bad, make it worse. And then they just paper it over or do something even worse on the flip side, on the 180.
Yeah, and it's never. I know that we are frustrated right now by a lot of pulling away of democratic control, where voters actually would get to choose their candidate. That's been removed from us. Lots of reasons to be frustrated with the politicizing of Fed and Treasury. Even if they push back, there's just no question. Even the mention of the Bloomberg OPEX op-ed by Bill Dudley. He did that before, right? He came out kind of last minute on a political maneuver to say, yeah, we need to cut. So it's a distrust. There's no question. There's a distrust of this political machine and the Fed and Treasury that supports it. And it would be wonderful from one standpoint to have a new voice like an RFK, because, and whether you agree or disagree on the policies, but I'm saying just because it would absolutely allow for some price discovery. I mean, if nothing else, but that's, again, still a long shot, but there is for sure a growing voice of discontent and independence. And I think that we have even if not this election, for the following one, it'll be much, much louder. So it might be quiet right now, but I think it'll be much, much louder into the 2028. But for right now, yeah, we have, I think, not a great backdrop for the market moving aggressively higher. We hit that 5650. It was a do not pass kind of level that I had. And if we do get above it, it will be very bullish. There's no question. For right now, their stuff is on sale. So we will see after the earnings season if it gets bid back up. NVIDIA, unfortunately, reports late, and that is absolutely the bellwether. But we'll get a look at Apple and FOMC meeting next Wednesday, where I think they will start to talk about accommodation. It'd be very surprising for them to do any rate cut suddenly. They don't like to surprise, but for sure September is already 100% odds, but now it has a 20-30% chance of a 50 basis point cut. So the point is, this is getting louder. We're getting into a place where I think we have Fed way behind the curve, and this suppression of the yield curve is not really accurately showing, right, our conditions. That's an outlier that's also, I think, ready to revert, meaning right now we have a short-term steepener in play. I think this is going to go back to inverting deeply. And when that happens, the next time that happens, for those who follow the 10-year, 2-year yield curve, that will hit banks hard. And the market right now has banks, which is why small caps are doing well, right? This is a very concentrated de-risking within the tech ecosystem. When banks get hit next, it'll also be bad for tech. So that's the thing to look out for next, is a further inversion of the 10 and 2-year yield curve, which I do think is coming.
And I think the banks have a lot of losses that have not been marked to market yet. That's with commercial real estate. That's with losses on auto loans, small business loans, variable interest rate consumer debt. I could go on and on. I think there's a lot of problems with the loan book. Foreign banks, the Japanese bank, only a month ago, the fifth largest one, they had enormous losses, way larger than expected on their older U.S. Treasury bonds. So I think the banks are starting to show some losses. We haven't seen major failures yet. There was 40 regional banks in China. They were just bailed out and rolled up. So they just took the little banks that had problems and rolled them up into larger ones and then just swept it under the rug. And there was no panic or financial crisis yet. I don't know how soon that will happen in the US, but I see problems with the banks if things play out the way you said. I want to ask you, though, about bull markets, though. Are there any sectors or industries right now where if things play out the way you think that will actually benefit from this, where there's weak energy prices, say for gold miners? So for gold miners, we just started Newmont Mining announced earnings yesterday on Tuesday, July 24th. And the earnings were pretty good. Yeah, their costs went up a little bit, but they have good free cash flow. Do you think the gold miners can actually, even if the gold price comes down a little bit, if energy prices are weak, can they still have a bull market in this type of environment?
So we actually, we touched upon this last time because it is very apparent that precious metals had been getting accumulated. And once they started to percolate higher and then take off higher, March 1st in particular, gold, right? Hot fire flames, silver had a big squeeze, 10% in 1 week, et cetera. The gold miners kind of hung back for a little bit, but that's very, very profitable for them. So you and I talked, I think Rick Rule had said, it's only in the second innings. So sure, as a trend, they look fabulous, but they are still going to be tossed about as the underlying comes down, and deflation, again, we get these deflation impulses, will be bad for gold and silver, the underlying. So that has to be taken into consideration if you are swing or trend trading gold miners. So I agree with you. They look forgotten, right? And central banks are still accumulating gold. But the point is, miners have been forgotten, and it is a fabulous place to go bottom fishing carefully. That's all. So I do think that's one sector that has had legs, and it's continuing. The other area, and it's boring, and I'm not usually, boring, sector rotation gal, but boring is profitable. You do have healthcare that has been, right, the safety trade, staples, utilities, defensive companies, even Lockheed and Raytheon and the rest. So you basically have a rotation underway where these proxies are already worried about recession. They're already worried about growth slowdown. They don't want to just be in the Mag 7 or NASDAQ. It's too overhyped, too overvalued. Now we've just had a come to Jesus moment for a bunch of them, but they still are just working on distribution and trend reversal. So the test will be after they get bought, right? After they get bought and make one more high, that's my bet, then we'll really get to see, I think, a reversal of fortunes. And that will be the test of whether or not small caps can hold up. Because if we lose banks, we will lose small caps, right? We won't just lose banks and tech. We'll lose banks and small caps. So I think we're going to have a tough sledding into the end of this year, but worrisome 2025.
So it sounds like you just described it's a bear market rally, short covering rally for small caps. We don't have proof it's a bull market yet. I mean, the Fed would have to cut interest rates close to zero, again, zero interest rate policy for the small caps to not have debt problems with their higher interest rate debt. But then the customers are dealing with on Main Street, because a lot of the small caps are dealing with non-affluent customers. They have less discretionary income. Their customers aren't able to pay as much or buy as many products or services with stagflation, shrinkflation, higher taxes. Maybe they're working 2 or 3 part-time jobs. So the small caps seem to have a lot of problems here. It does not look like a bull market for small caps.
It looks like an early trend reversal that needs confirmation. So I just want to kind of reiterate that. I'm very bullish if it does not break down below that breakout level. So right now, if you think about it, the S&P finally had a 2% drawdown, right? Day. First time in 356 days. Big deal. The top 7, so let's call it the S&P 7, lost $1 trillion. in market capitalization in one day. That did not rotate into small caps. That's not a rotation. It just left.
That capital, that liquidity, is it parking in short-term U.S. Treasuries? Is it going to cash, U.S. dollars? Where do you think it's going?
I don't know, but Russell, 2000 collectively isn't worth $1 trillion. So if it went into small caps, it would have doubled. No, that's not how it works. So it just left. So we don't really have, quote unquote, the rotation. We had small cap hedge fund factor rotation, short covering, and we had the concentration risk, de-risk, and money left S&P 7 or Mag 7 or however you want to put it. That's what I'm looking at right now is where are we going to go from here if we don't have a broadening out of small caps because we lose banks, we're just going to have a market fall. But I think that's going to be, again, mid-August into September. We know seasonally speaking, VIX usually bottoms on July 17th. It wasn't any exception this time. So the real test is once I think VIX hits 20, comes back in, we get a bounce in growth, and then let's test it. Let's really see what happens on that one more high in markets, SPY and NASDAQ. Then we get a really good test to see if small caps are gonna hold up. My guess is that banks will be in distribution and they will not, but it's too early.
So for some of these defensive sectors that you talked about earlier, are we seeing bullish signs like dividend growth where people can just buy and hold these defensive plays, start allocating to there, and they can expect to be compensated with dividend growth, free cash flow growth, or are we not seeing that?
Oh, I mean, energy companies are still fabulous for that, right? But they're not going anywhere fast. I mean, in other words, they're not momentum plays. Oil, it looks weak, but the energy space looks strong. So yeah, I think we do have even early innings for earnings, according to FactSet anyway. They are beating estimates, but only by 5.5%, which is worse than the 5-year average of 8.6%. We're on a decline here from the earnings that we've had for 6 quarters that was relatively flat, and the market analysts expecting a 17 to 20% forward, right, earnings growth that is not getting materialized. It's just earnings bar is just too high. So the ones that are beating, right, is really in the value space, we have to admire. But it's not going to be the momentum that we've had for the past, basically since January of 2023. NASDAQ stopped going down and we advanced 90% or 91% from that trough to peak before the recent pullback, right? With the NASDAQ 100 QQQ hit like 404, 405. That's into almost, a 10% pullback. That is what we have to go and test again. There's going to be, I think, a very choppy end of the year. And not just because of this, because we've already hit all my price targets. Like in January, I had a price target of 53.40. And I said, once we get above 53.40, that's very bullish. And we went up to 56.50, where I said, nope, I'm done. I don't think we're going to go past this. So I'll be wrong if we get and stay above 56.50, period. And we can keep chugging up to 6,000. I have to be the if-then girl because I don't see right now a great risk reward for betting on that. I absolutely think we're going to make one more high, but I have a hard time believing we're going to keep that high. For all the reasons we just talked about, higher unemployment, global credit demand falling, the crowding out, Fed behind the curve, election risk, the carry trade unwind, all of these reasons, I am still very, very suspect, especially through August and September. And I think Fed rate cuts will trigger, but I do think that it will be a diminishing rate of return as it relates to equities getting a very solid tailwind into, let's say, 6,000 end of year. I think it's going to be hard pressed to get there. In fact, I think we have a better chance of going back down to the November 1st pricing. What was that, about 4,300?
Can't remember offhand. I mean, I was just focused on what you said about oil and natural gas companies and how there's dividend growth there. I mean, they're unloved. The valuations
Yes.
are cheap.
Yeah.
The last 18 months in the oil and natural gas sector, there's been over $230 billion worth of deals, mergers and acquisitions. So these are company executives that are running the cash flow projections, the valuations, saying, I can go and buy assets for cheap. And once the acquisition is done, I have a stronger, more diversified company. So I think that's going to continue if valuations are going to stay cheap now, because you're going to see the companies that don't have a lot of debt, they're going to go and buy assets. And I also think we're going to see the same thing coming over the next 6, 12, 18 months in the gold space.
Yeah, and even the Chevron doctrine and all of that, which removes a lot of regulation, has helped some of these otherwise unattractive value plays pop up and get more subscription or sponsorship because of dividends, like a Philip Morris and the like. So yeah, I think there's a lot of opportunity, but that's not very sexy for a lot of momentum traders.
Oh yeah, I agree. But if you're running a gold mining company or copper miner or oil and natural gas, you have to deal with depletion risk. So you have to go and buy more reserves. So if you can't find them through exploration, you have to go and buy the reserves then, or resource. So you have to go buy something. Otherwise, a few years from now, you're not going to have any reserves left to produce. So this is one of the major things about the whole natural resources commodity industry that the other industries do not have to deal with is if you're an oil producer and you're pulling insane amounts of oil production out of the ground and you're depleting it rapidly, you have to go replace the reserve somehow. Same thing for the gold miners. I mean, Newmont is producing an insane amount of gold. It's going to be very difficult for them to find additional gold reserves at a low cost and maintain the ore grades. It's going to be almost impossible, I would argue, actually 10, 15 years from now.
Well, and I think we also talked about efficiency, right? The gold miners that are very inefficient actually respond higher beta to the underlying price of gold and silver versus those who are more efficient, like a Newmont. They're slower and lower beta to the underlying. So they will probably chug along just fine relative to a smaller miner. So all of that is what I select for clients. Like when I'm going through and I'm saying, okay, we have a sector rotation in miners. These are my favorite ones and why. Or we have a rotation, in semiconductors, whatever. These are my favorites and why. So this is all part of really timing sector rotation and then stock picking, right? This is where we're at right now, where we have basically come back down from a very high point for all kinds of good reasons of letting some valuation air out of the balloon. Now we have to see if Fed is really going to follow through because they fear that it's getting a little bit unwieldy, all this crowding out, unemployment moving higher, global rate cuts, et cetera. I really think the election risk is an underweighted risk. And the carry trade unwind, very few understand, or they overestimate. That can take a long time, slowly then all at once kind of thing. It's not going to happen this month. It's not going to happen next month. It's going to take months for it to even really do its beginning damage. So
are you referring to the yen carry trade, or is this a different carry trade?
No, the yen carry trade. Forgive me. Yes. So I just think a lot of folks are focused on one component, and we have a number of them in play right now that the Fed and Treasury intervene and try and balance, right, with making sure dollar doesn't get too high, yields don't get too high, that rate differential doesn't get too out of control. But over time, they lose some of their effect. And who knows what happens if we do get a new sheriff in town, and what happens to the heads of Fed and Treasury. So we do have a lot of election risk that I think is not priced in.
Well, I think one of the reasons that fifth largest Japanese bank, I can't remember its name offhand, that they started to have problems. And so they told the market that their bond losses on older U.S. treasuries were larger than expected. But I think also the yen carry trade, they were one of the major players there too, because a lot of the Japanese banks were funders. They were funding a lot of the yen carry trades, or at least they were loaning out the yen carry trade.
But do you remember what happened immediately after they said they were going to sell more? I know this bank that you're talking about, the U.S. slapped currency manipulator on Japan as a way to say, don't you dare.
Well, I mean, Janet Yellen kind of saw this 9 months, 7 or 8 months ago. Didn't she go? She went to visit Japan afterwards. So she kind of saw that this would happen. And then I think they were negotiating behind the scenes for some type of currency swap line. That Japanese bank in particular, though, about a month ago, I heard from another hedge fund manager that the Fed had to set up a separate like reverse repo line or currency swap line with that
Wouldn't
Japanese
be
bank.
surprised. Yeah.
Well, because they're a market maker for collateralized loan obligations, they decided they wanted to pull like an MF Global. They wanted to be a big shot bank. And so they borrowed way more and they set up a market maker for an enormous market maker business for collateralized loan obligations. Then they're not a large bank. So the Fed figured out, oh shit, we need to make sure that they don't start dragging other banks with them. And they set up like a liquidity facility for them behind the scenes. This is the type of stuff we have. I think there was a press release behind the scenes or something that the US and Bank of Japan were coordinating. This was like a month ago. Didn't they say that they were coordinating
It was on or about June 22nd because that's when I basically said that I'm sorry, that's when the United States placed Japan on a watch list for currency manipulation. It's all financial. It's all financial repression, right? Sometimes coordinated, sometimes coerced. And in that particular case, I have no doubt it was, US is giving political pressure on Japan not to dump their US treasuries.
Bingo.
Period.
Yep.
Period.
Yep. And if Japan wasn't a vassal state, they'd be accumulating to protect their currency instead of necessarily debating raising interest rates. They would be diversifying the reserves and buying gold tonnage, but that would just piss off DC.
Correct. And if the US treasuries were fundamentally strong, there'd be no need to put Japan on currency manipulator watch list.
It's so ridiculous with the currency watch list because they were discussing like currency swap lines and stuff to help stabilize the yen and the exchange rate behind the scenes because they didn't want the yen running to 170 or 180 too quickly. I don't think anyone wanted that because then, like you said, it would blow up the yen carry trade and then that would cause problems for the banks and hedge funds here.
But if the dollar yen also breaks that 152, which is a major level of support, it will also drive the yen higher, which can trigger the yen carry trade unwind even more. Ugh. So they're screwed. They are, as far as I'm concerned, they're screwed if they do, they screwed if they don't. But that's definitely the range we're working in right now, 152 to 162. And more likely, we'll see what happens. But it's fascinating that we're kind of on the same page with that. Currency manipulator, quote unquote. The yen is a political tool.
And the large banks here in the US and the large European banks, they seem to be making more money as hedge funds with these leveraged bond trades or leveraged currency trades or derivatives trades than they do with normal bank lending.
Oh my goodness, bank lending has absolutely flattened and fallen. Not severely, but I mentioned Jeffrey Pouvret, who is one of our two macro advisor edge managers. And he's a classical economist, and he really gets into the nitty gritty with all things banks. And basically, he follows that NIM, trajectory and lending. And oh my goodness, it's falling. There's no question that loan demand is falling. Household, corporate, government. So we definitely have need to watch the banks closely, and that's why I say, okay, small caps are doing well so far. A short covering could turn into a trend reversal, but not if we lose banks.
I think we're going to see bottoms in some of the commodities that are going to surprise people. I think risk reward, the contrarian plays right now, natural gas companies. The U.S. natural gas price is low. If Trump wins the election, he's going to prove more liquefied natural gas export facilities, which would be profitable for a lot of U.S. companies. And then like the platinum and palladium miners, they've been in a bear market for a while. The platinum and palladium prices are below the cost of production now for a lot of those miners. So in the BHP deal, they didn't even want the platinum and palladium assets when they were going to buy Anglo American.
Yeah, I don't see any interest, honestly, in following platinum or palladium. They just don't move. So I'm interested in uranium and, as a ancillary, but the one I watch every single day very, very closely is oil. So for right now, we have a situation where the market is in pullback mode. and yields are softening, and we have to see if we can get commodities up off the ground. But I don't see a case for that right now, especially with yield softening. And that goes for oil. Risk premium has been pulled out of that trade, and there is a risk that it falls further even with a Trump, potential presidency. I just don't see right now a lot of advantage in going hot and heavy in commodities and or other than the companies that are tied to assets. I'm very fond of that. Very fond of things over paper. I'm very fond of this whole dividend strength and fundamental, free cash flow, and they're in great positions. Fine. There are coal companies, there are oil and gas companies, but as a commodity focus, I'm not a commodity focused trader. I look at whatever is moving right now and what I need to project is going to move next. And right now we're clearly in a rotation of safety pays.
Okay, that's very interesting. So defensive for now, what that means, more cash or short-term U.S. Treasuries, defensive and waiting to see if anything that people might want to buy that was too expensive for the last 6 to 12 months goes on sale then?
Well, I don't look at just the 6 months because the rotation could end right now, tomorrow, and we bounce up, we pop up like a daisy in the Mag 7 space right back up to the prior highs. So again, I'm much more active trader and investor. But what you're saying is my interpretation of the risk reward of going blindly into tech is over. And money is much more valuable right now. It's not disposable. They're looking at that. They're removing that risk. They're de-risking out of the concentration plays. And where they deploy it is what I'm following very closely as well. And right now they are deploying it, and they have been for actually a few months, into safety. So yes, healthcare and staples and defense and utilities. Oh my, boring, but it's working. So I don't see how right now that's going to change. That's my only kind of point in this, because I do see the very high likelihood that the Fed cuts and cuts more aggressively than is priced in right now.
Okay, last question then. What do you think is the probability over the next 12 to 18 months that DC policy-wise, whoever's in the White House, whoever ends up controlling Congress, screws this up royally with bank failures or lowering interest rates back down to zero, or bailing out banks, or bailing out a foreign bank, it's not just a U.S. bank, or a commercial real estate collapse, and we get $3,000 an ounce gold in the next 12 to 18 months? Do you think that's a high probability that we get a big gold spike?
This is a gold spike question or a recession question, because what you just set up was basically recession. And there's this, kind of bar shock that can happen where even gold is sold off indiscriminately when trying to raise cash, even during COVID, right? We popped up and then we dropped aggressively in gold. Bonds stopped going up in August of 2020. But the point was that it's not, that's a collateral trade. Gold is a collateral trade. So it can be sold off very aggressively. We have a long ways to go in, getting the recession front and center and yields dropping precipitously lower. That would be honestly cash driven rotation. In other words, as the dollar went higher, it would also put pressure on precious metals, even if it's for a short duration. So I can't project what we're going to do in 12 months to 18 months until we can really see the policies that come out of DC. But I can see that this interference of policy has a limited runway. It is losing its effect. So I am definitely growing more aware of the impact that a yen carry trade could have, that an election risk could have, that aggressive rate cuts and recession pulled forward could have. There are still a lot of bullish backdrops, by the way. I mean, earnings are still strong. Consumers are still spending, even if nominal growth from government is in play. and Fed and Treasury have our back, that just means we're not going to fall apart, but that doesn't mean we're going to grow aggressively. So I'm not calling for gold to spike any particular price target. I want to see what we're going to do first and foremost with our monetary policies and then how the market reacts. Bonds look done going down for now. And honestly, equities look done going up for now.
You brought up that gold did sell off briefly in 2020 and then it spiked up. I mean, very similar things happened in 2008. And then by 2009 to 2011, gold had started to rally enormously. It hit 1900 for the first time. So in 2008, I think gold was around 11 or 1200 and it dropped to 800 briefly. So it did drop a lot. People were pissed off. And then the Fed lowered interest rates down to zero interest rate policy, changed the accounting laws for the banks, did quantitative easing, expanded its balance sheet. And then gold rallied enormously over the next 2 or 3 years up to $1,900 for the first time. So we could see something similar play out, like you said, where there's a margin call, banks, hedge funds, other people sell gold off temporarily. There is I don't know, 20% correction or something like that, maybe more. It depends how much leverage was used on the gold trade. There was a record amount of gold futures contracts long, I think, in the last couple of weeks. There's a correction, and then the central banks do something really, really stupid, flood things with liquidity or lower interest rates, and then here we go again. Then gold's blasting through 2,500 because 12 months ago, I mean, if people would have said gold was going to hit 2,500, I would have said maybe in a couple of years, and then we almost hit that in a couple weeks ago.
Yes, but this is two parts, right? Gold loves loose monetary policy. And we really had that Fed pause and Yellen Yahtzee November 1st, also back in March of 2023 with the bank backstop. And it does not like these deflation impulses. And it will really fight a spiking higher dollar. So it's in, fits and starts, but long story short, it is still a beautiful trend trade. There's nothing wrong with this big picture. I'm just talking about more of the durable, active trading and investors who are my clients, how to manage some of that protection from the trend long trade in gold. So there will definitely be, like you just mentioned, particular events that will spike it higher and then dump it because it's still a collateral. And central banks are still using it, right, as a form of a replacement in usually U.S. Treasuries for obvious reasons because of our fiscal deficit situation and our also mismanaged everything from legislative to judicial to monetary to fiscal. It's a mess. So there are reasons for owning gold. I don't think those are going to go away. I'm just talking about more active management of it. But for right now, it is fine. It is still a very, great source of value. Even if it doesn't produce a yield, it just loses some of its, let's just say, optionality when we get a dollar spike. So that's what I'm always looking for. That's not the situation right now. Right now, we have the dollar. We have currency easing. We have the dollar suppressed as much as possible as foreign countries are doing their local deval, and that's helping to a degree U.S. corporations. But I think that's going to be challenged into the end of the year and 2025.
The difference, though, that you laid out that would restrict demand for gold by American citizens. And we're seeing that the bullion dealers here in the U.S., they're not selling. I think A-Mark, which is publicly traded, they just said that their sales for American retail investors for gold are down enormously. But the demand spike for physical gold, it's because of the currency weakness in Asia. So like China, Japan, Korea, Thailand, Vietnam, India, those countries are the ones where I would say since October, the marginal demand increases for retail investors for gold has been absolutely enormous. So that's been the demand driver for gold lately. Like the central bank buying has been like dollar cost averaging. It was all the retail investors in Asia that bought a lot of physical metal that no one saw coming. And that's why we had the big spike in gold.
Yeah. And a few months ago, I put out a chart, which is a ratio of silver and gold. And I said, this is the most bullish chart I have. It's still very bullish. But again, it can still have lots of ebbs and flows. So those are what I am actively spotting and setting up for clients so that they can actively trade and protect against. Anyway, this is only one component, right? I think the dollar and yields are more of a driver, so I focus on those. Secondary are oil and gold, and how they're used and how they react. And right now, sector rotation between tech and value, but the reasons for that rotation, and I think a lot of folks are, pulling forward a lot of rate cuts into a bullish small cap rally, when in fact it is part of hedge fund factor rotation, short covering, and Fed cuts getting priced in, but it's not necessarily that bullish if growth slows. So that's where I think the watch on banks is most critical as we move into the end of the year.
I want to thank you so much for your time today, Samantha. I really enjoyed our conversation. If my listeners want to check out more of your work, how do they do so?
I have a website, and thank you so much, Jason. It's always a pleasure to talk with you. You have such deep knowledge, especially in this commodity space. I have and political backdrop as well. I have a website, LaDucTrading.com. I am not alone. I have actually a very strong trading desk of 10 from macro to micro, analysts, educators, and traders. I also have a Twitter, presence, X, and it's at Samantha LaDuc, LADUC. The website is LaDucTrading.com. I have a Substack, delayed posts, but you get a kind of a feel for some of my macro to micro analysis. And I run a live trading room, as well as provide a lot of trade setups across chase, swing, and trend timeframes across all asset classes. So thank you very much for the time and for the exchange.